Hi, welcome to Tab's 2 Cents. Today on the show, we have Peter Sainsbury, and we're talking about carbon. Hope you enjoy the show.
Welcome to Tab's 2 Cents, the show where we discuss multiple income streams and macro factors affecting the world today.
Hey, Peter, welcome back to the show.
Hi, Joe. Thanks for having me back.
Yeah, of course, anytime. It's always a pleasure. I thought we would start this episode. I know you and we've discussed carbon a lot. And if anybody's interested, they can check out those videos where we dive into it right away. But you're also an economist. And I thought we could just talk a little bit about the macro picture where you sort of see energy and especially European energy, because that's more, it's obviously where you live, where you see that going right now.
Yeah, that's right. I mean, I'm based in the UK, so I'm, very much seeing it from perhaps a European perspective. But clearly, going into winter, back early 2022, there was a real sort of fear that there'd be a scarcity of energy. Prices were going to record levels. Whether it's power or gas, and there was a real concern about industry shutting down. A really sort of deep recession going into the winter, and I think that's clearly affected lots of different asset prices in a consistent way, whether that's carbon or broadly on equity markets and elsewhere as well. But I think since about sort of October, November time, there's been clearly been a sort of shift in the narrative away from that sort of very grim outlook to maybe a less grim outlook for the future, and part of that was down to perhaps a warmer than expected autumn and winter in Europe, which allowed us to fill our gas inventories back up towards maximum levels much quicker than many expected. But there was other things like LNG imports and some kind of energy efficiency that certainly helped. But I think it's that shift in narrative, I think, that's been very important. That I think has been reflected in lots of different asset prices, whether it's carbon or other markets as well. And that's to the extent that the economy, at least up until now, has looked to be better than what many expected. Here in the UK, just speaking about UK specifically, it's the outlook seems to be that we are perhaps the sick man of Europe in many ways. Other parts of Europe seem to be doing lots better, and are likely to do much better in over the next year or two as well. So there's a difference in outlook, but it's certainly concerning as well.
Yeah, for sure. And just given all of the things that happened with natural gas, especially in energy prices, what has that done for the overall sentiment for net zero and renewables? Has it been a pro or a con in that direction?
Yeah, I think certainly here in Europe, the sentiment has been that it should be a driver towards accelerating that process towards net zero. I know elsewhere in the world, perhaps maybe North America in many respects, that it's seen as the opposite. That we should Europe's gone too fast towards renewables, towards net zero, and that they've made a mistake in that respect. And I think you can argue both ways, but certainly the view of politicians, and I think it's broadly accepted by citizens as well, is that the best way to reduce our reliance on Russia, Russian influence in terms of energy markets, is to accelerate that process, not to go back and go back towards fossil fuels, whichever that might be.
Yeah, that's really interesting. And does it seem, are the politicians, are they sort of pushing that as a energy security? Is that why they're going that way, or is it still carbon?
I think it's that energy security narrative. That wasn't really obviously discussed before the Russian invasion. to any great degree, but that's clearly the number one issue at the moment. But I think what was what many people thought was going to happen in the aftermath of that events about a year ago was that Europe would suddenly decide to abandon all its climate policies and double down on energy security. But that hasn't happened. It's it hasn't abandoned those plans to meet net zero. If anything, it's actually accelerated that process.
Yeah, I agree. I thought that perhaps they would sort of abandon, as you say, a lot of those policies, and
or at least row back on it.
Yeah, and we could end up, in a place where they're not so focused on carbon and more focused on, energy security. But it seems like it sort of shifted in a direction where they're doing both. And yeah, so with that being said, we can move on to the European carbon market. I know you just came out with that article, 11 Ways to Gain Exposure. I wonder if you could talk a little bit about those and your favorite ways that people can maybe gain exposure to the EUAs and European carbon market.
Yeah. I mean, this is part of what I do at Carbon Risk is to try and help investors navigate these markets, not just the European market, but other carbon markets as well. And one of the questions I always get asked is, how can I invest in this market? What different ways are there to get exposure to it? And I think there's it's certainly grown a lot over the last year or two. As it's become more accepted as an asset class in its own right, or a way to diversify from other markets. And I think what you choose depends partly on where you are in the world. Not all these products are available everywhere. It depends on sort of tax implications and things like that. But certainly if you're based in North America, then there's the original and the biggest fund is the Crane Shares KRBN fund, which invests in like a basket of different compliance markets, and I think around about sort of 60% of it is in the EU ETS, with the rest mainly sort of other North American markets, the UK. I think that's broadly it. But if you just wanted a sort of direct exposure to the EU ETS, Crane Shares also do an EUA fund, which is very small. So there's some issues there. But I think the other sort of main way is to invest in there's a fund by a company called Spark Change, where you actually buy the physical certificate, if you like, the physical allowance, and that has perhaps some advantages over in the futures market, because it's these allowances are limited. There's a scarcity. By actually buying a physical allowance, you're actually removing that from the market, which means the obligated emitters that need to purchase these allowances to demonstrate that they've complied with the regulations, need to potentially bid more for those allowances, which so you're indirectly contributing to that scarcity in the market. And I think there's a few other interesting things. There's a kind of a sort of blockchain investment vehicle that's launched recently, which seems to be, I think it's just still early days at the moment, but that could be quite interesting. And then there's various other things depending on where you are in the world.
Yeah, and I think it's interesting. The more that I dig into energy and net zero and policies, it seems like there's more promises every day, and a lot of the consensus around energy experts, let's say, is that these companies aren't going to be able to meet those promises. So the only way they're going to be able to do it, in my view, I think, would be through carbon offsetting and carbon credits. So I think if you're bullish on the net zero, idea, then these companies, it's going to be really hard for them just based on the materials and energy input and, workers and specialties and all these things that they need to switch to that, lower carbon production.
Yeah,
They're going to need the credits. So I noticed one
I
thing that
think
you said is that the voluntary market is at the edge of the carbon market risk curve. And I wonder if you could just elaborate on that a little bit. We can move into the voluntary side.
yeah, I think let's just take a step back first, just so we're clear about the the difference between the the regulated compliance market, which is
Mm-hmm.
the EU ETS, which I was talking about. That's that, like I said, that's a regulated compliance market. It's like the EU market's been going for almost 20 years. The voluntary compliance market is where, say, a company like Microsoft wishes to meet its net zero commitments, partly by reducing its own emissions, but partly also by buying carbon credits. So you need to keep that distinct from carbon allowances, which is what you get in the regulated compliance markets. So with those carbon credits, as I said, in a recent article, I described them as on the edge of the risk curve, and I think that's for a very good reason, is because there's a lot of uncertainty about how they're going to work. It's still a very nascent industry. It's only, I think it's only sort of around about sort of $2 billion traded last year versus something like $800 billion in terms of the compliance market. So very different scales. But then, having said that, the voluntary market, the carbon credit market, could grow massively over the next 10, 20 years, potentially up to 100 billion to even $500 billion. There's massive potential for growth. But as I said, it's got all these risks attached to it. If you're buying a carbon offset related to a forest in Indonesia or somewhere in Africa or wherever, there's lots of issues related to the baseline at which it's measured against. Are these actually real emission reductions or removals from the atmosphere? Is the forest going to burn down or suffer some due to some pest disease in the future, which isn't accounted for? Another risk is that you might be protecting one region of the forest, but maybe all the loggers and all the illegal development just gets shifted to another region as well. So you're not actually solving a problem; you're just moving it to another place. So there's lots of risks attached to it, but I think that also comes with opportunity as well. And at the moment, there's the sentiment to the sector is probably the lowest it's ever been. Partly that's due to these these sort of media articles about these risks that I was talking about, and they're right to highlight them, but what we've got to be careful about is that we don't just abandon them just because there's a risk attached to it. These are going to be essential to help meet both obligations by companies, but also government commitments in the future as well. And so I think what we're going to see is lots of innovation over the next few years about how to price that risk, and so that when companies and other stakeholders talk about we've invested X amount in a certain type of carbon credit, they can actually say it's got an expected return of so many tons of emission abatement or emission removal. So there's lots of opportunities in the sector, and I think as I said, sentiment's so poor at the moment that it's looking quite an interesting opportunity from the upside.
Yeah, for sure. And I know, especially here in North America, there aren't really a ton of people talking about carbon credits and carbon pricing. Wonder what's it like in Europe if you out at the pub or whatever. Does that ever come up? Because here it wouldn't for me.
No, it's probably the same here. Really, is that it's a you can think about it, the carbon market, in different ways. Whether it's a type of commodity or a currency, some kind of asset. But I think it's still such an early stage in its development. But it's over the next 10, 20 years, it's it's going to be so scarce in terms of carbon credits and carbon allowances that it could become a fundamentally important asset class in its own right that drives lots of other important decisions, whether that's whether to invest in every sector of the economy is going to be affected by what the carbon price is or expectations of the future. So no one's really talking about it down the pub at the moment, but I think it's that will change over the next few years.
Yeah, I agree. I think that because it's so early and it's kind of confusing as well because you have your
Yeah,
compliance market and then you have your voluntary and then you have all these different types of credits and different ages and vintages, as they say. So it can get you can get very in depth with it, especially when you get into
yeah,
like double accounting and all these things that go on, and it's just a very technical process. But I think
yeah,
that as we move forward, and maybe some of these blockchain solutions will help in clarifying exactly what carbon is. One thing I wanted to ask you about, I'm kind of flip-flopping back and forth a little bit, so I apologize to any listeners, but in the compliance market, EUAs, they're floating around 89 euros at the moment. And this happened last year where our price rocketed up to 90, 100 around January or whatever it was.
mm.
And then it crashed in February down into the 60s. And I'm just wondering what your thoughts are on that. Are we still seeing some risk from the market stability reserve? And where do you kind of see that outlook going in the compliance markets?
Yeah, absolutely. And I think it's important to say that the compliance market, the EU market in particular, if Europe wasn't committed to that, it'd be very difficult for these other markets to develop, including the carbon credit market as well. So it's almost like the bellwether price that affects sentiment throughout the whole of the sector. And so yeah, you're right. This time last year, the EUA price was around about 90 euros a ton, and then we had the Russian invasion. It collapsed to around about 65, maybe a bit below that, and and since then we've had this lots of volatility over the past several months, but it's gradually sort of been traded in those sort of around about sort of the 75 to 85 euro per ton range, broadly. But yeah, as like that 12 months ago, we had this surge in prices, and part of that, I think again, going back to October, November, sentiment was very poor. We had everyone was thinking there was a recession coming, which would be negative, very negative for emissions, both from the power sector and industrial sector. That got the outlook became less bad, so prices really rebounded from that. So that was one factor behind the surge in prices. But then we also had this agreement in Europe on the Fit for 55 package, which is the package of measures which takes Europe further through this decade and helps it meet its net zero commitment. So part of that includes an agreement on how the supply of allowances will gradually decline over the next several years. So that was an important milestone. The other important point was at the moment, the EU ETS just covers the power sector, and industry has a very small, they pay a small percentage of their allowances. But over the next several years, that's going to get higher and higher and higher, because at the same time, Europe is introducing what's called a carbon border adjustment mechanism. So now, if you have to import, say, fertilizer or steel or any other kind of very carbon intensive material into Europe, in the future you'll have to pay a border tax, essentially, which will be linked to the European carbon price. So what you could get is lots of companies trying to hedge that position by buying EU allowances in advance, because they know they're going to have to be purchasing, potentially be paying the tax in the future. So this could be a way of hedging that future requirement. So all of these factors have kind of led to an increased confidence that the EU carbon market will become tighter and tighter over the next sort of several years. But then set against that, every year there's going to be sort of bullish and bearish factors that affect the more sort of shorter term outlook. And so in Europe, we're probably going to have a rebound in nuclear output, in renewables, sort of solar, wind, hydro, and that could sort of squeeze out some of the thermal coal generation, which had started to come in towards the back end of last year. And so, coal generation, highly carbon intensive. If you do need to burn that, utilities would need to buy carbon allowances to help hedge that carbon risk. But if we get this sort of growth in zero carbon generation, then they don't need to hedge that in the same way. So there's what I potentially see is some sort of bearish shorter term outlook, potentially as this these renewables increase capacity. And I think you alluded to the market stability reserve earlier on in your question. That's changed slightly from where it was 6 months ago. So for the benefit of listeners, the market stability reserve is a mechanism which every year it takes a set proportion of the allowances in the market away, locks them away so that it gradually tightens the market. And the fear 6 months ago was that the European politicians were going to mess with this mechanism and release a lot of allowances, and that would in some way sort of jeopardize the whole premise behind the European market. So what they've decided to do is actually, instead of that, they're going to actually front load some of the auction allowances from later in the decade. So they're going to be bringing that forward. So that's kind of bringing forward supply and then auctioning it off in 2023. So that's another bearish factor for this year. But just because you brought it forward, that means there's less supply in the future. So it might be near term bearish, but longer term it's a bullish factor potentially.
Yeah, the MSR is interesting. I look at it a little bit like the SPR in the States.
Yeah.
Where it's sort of like, you never know whether they're going to flood the market with new barrels out of the SPR, yeah. But it's a little bit different because with oil, they need to get that oil back. They need to buy it back. And with the MSR, instead of buying the oil back, you just know that if they put it into the market, they're not getting them back. There's no production of credits like there is with oil, where the producers ramp it up. So it's kind of different, but kind of a similar idea where
Yeah.
politicians sort of control that price. And I just think it's a little bit interesting. Another thing you brought up was with energy and nuclear, and how emissions could potentially be going down in that direction with innovation. And I know in the compliance markets, it's based on an industry average. So, per megawatt, you get however many credits, or, for an industry standard. So coal gets charged the same as solar. So then those guys, they can make money because they're obviously lower emissions than coal. I wonder if there's some industries that you're looking at that could be, right for innovation. Let's say, obviously, energy is one of them. If you can displace coal with solar, you're probably going to be rewarded with carbon credits. And I know that you've also mentioned like meat and dairy. If, somebody finds a new way to, produce meat without as many emissions from their cows with a new feed, or, a different, fertilizers or whatever they do. I wonder what industries you were looking at.
Yeah, that's right. So, we've been talking about the carbon price as a, almost like an asset, something to invest in, and, for it to go up in the future, or the hope that it will. But the whole point of a carbon price is that it you want it to incentivize action. You want to encourage companies to invest, for consumers to take account of the carbon price in their everyday purchasing decisions. So that's the point of the carbon price. So I've tried to I've become increasingly interested in what sectors are going to be affected by the carbon price, where the opportunities in terms of innovation and investment to as people and industries start to take account of a higher carbon price future. And one of those sectors, like you mentioned, is the meat and dairy industry. They're one of the most heavily emitting sectors in the global economy, and then it's not just about emissions. They result in deforestation, lots of other forms of air and water pollution as well. And so there's lots of innovations going on across the world. Some of you mentioned, like reformulating animal feed so that once cattle consume it results in less methane emissions. There's other innovations such as things that capture those emissions rather than actually them being released, and and almost incentivizing people to change their diets, potentially to alternative proteins. And I know the sort of narrative around this tends to result in things like insects being grown as sort of protein, as a alternative protein. But I think the potential growth markets are things like cultured meat. That's distinct from plant-based meat, but cultured meat, where you get these sort of big bioreactors, and you're taking a single cell from an animal, and then you're manufacturing meat and other products on a massive scale. And I think that's quite an interesting area of growth potentially over the next 10 years. It's very much restricted at the moment based by regulations, as it should be. Europe, other countries have very strict rules on new foods being approved. So that will be the obstacle. But I think as countries move in that direction, I think the demand and then the supply of those products are going to increase.
Yeah, I completely agree. When I first started looking at carbon credits, my thought was the largest emitters would have the most opportunity to capitalize because they're given the most credits. So then, therefore they can, if they cut their emissions, they'll have more credits left to sell, was one thought. But I think as I've progressed through this, I've also learned that those same emitters are also some of the hardest ones to reduce emissions in. Like, for example, mining, it's just really difficult to mine anything without gigantic diesel engines
Yeah.
digging up the dirt and trucking it different places and refining it and stuff like that.
Yeah.
One thing I have looked at is renewable natural gas, which they capture from landfills,
Yeah.
and they actually have in California, they have like RIN credits, so they have so much percentage of their natural gas has to be renewable natural gas.
Yeah.
And I don't know if there's anything else that you've looked at with similar sort of carbon credit, like the RIN credits, where the government can kind of amp up how much. It's almost like ethanol, like how much they have to put into
Yeah.
their product.
Yeah. I mean, I don't think there's anything comparable in Europe. I think I noticed this morning there was an article about Goldman Sachs investing in a biogas investment based in Europe. I think it's relatively small compared with the amount of investment that's going to be required over the next 10 years. But I think it's it's interesting how that's going, because like you said, you've got all this gas from landfills, potentially also from agriculture as well, that's potentially could be captured and channeled into various either residential end uses or industrial uses as well. And again, that kind of feeds into the energy security narrative as well, pivoting away from the actual sort of fossil natural gas.
For sure. Yeah, I just thought that was interesting because I
Yeah.
agree. I think the opportunity is to find those companies that are kind of innovating in those spaces that are carbon intensive, and it's a tough job because it's all very new technology, and you
Yeah.
also have to think about all those political and macro factors that we discussed earlier. Is it going to matter in 20 years that these guys are carbon free or not? And it's just, it's all part of the risk. Before we, that is actually the next thing I was going to bring up was, this is a good segue. You have your book, The Winning Formula, so betting on F1. And I thought I would ask you if there's any lessons you learned from that in risk management that you carry over to kind of investing that you could learn from gambling and risk management and hedging that you might do in the investing world, and also some of the risks in carbon and how you might want to hedge those.
Yeah, that's an interesting question. I think whether it's investing or betting or trading or anything that involves large degrees of uncertainty, it's all about everyone thinks it's all about finding an edge and exploiting it, but a lot of being able to survive in the long run is about risk management and understanding the probability of what you're betting on, what you're trading in, and asking yourself consistently whether that actually represents is there value there that isn't being captured by the market or captured by other people. So I think that's a lesson I try and take when I'm looking at things from an investment point of view, is who's on the other side of that trade, and why is my insights not being reflected in the market, or what other insights other people have which might suggest the price should be lower or higher than what I believe it should be. So I think that's probably a valuable lesson. And I think from a carbon perspective, carbon is a I think it's going to increasingly become a way for companies to risk manage their portfolios, whether that's their investment portfolio or their production, their operational portfolio. And so, as these markets develop, what we want to see is more confidence in if you're buying a certain allowance or credit, that's actually going to deliver what you expect it to do. And so people can have a reasonable expectation about what kind of impact they're having or risk that they're trying to manage. And so I think that's where things are going to go. It's become carbon is going to become much more of a risk management tool across the economy.
Yeah, that's interesting. It's almost like crypto in some ways. People would say that you're sort of hedging against the dollar or gold or whatever you want to say crypto is. But it's like it's such a new asset that it took some time for people to understand it. But now you see certain companies are taking positions in crypto just more of a hedge than anything. They're not necessarily betting that the price will go up. They just, if their assets go down, they want to have something that might go up because it's sort of uncorrelated. Although there's arguments there that it is. Lots of people say Bitcoin's a tech stock because it's so correlated to the NASDAQ 100, but that's a whole nother discussion. The reason I brought up betting is I think it's interesting because when you're live betting, you can see the odds move. So, here in North America, I'm Canadian, but I like to watch football, and you can see the odds kind of shift for the over-unders or the spread, the point spread. And you watch that in live time, and I've thought, oh, wouldn't that be interesting if you could see that with stocks? But I think that you can, because what you watch is valuations. So, depending on the valuation, it's almost like a live feed, just like betting odds.
Yeah, I guess the difference is you're seeing the action in front of you, and then the market, the betting market's trying to interpret that action live in front of you. So in theory everyone's got the same access to that live feed, whereas I think with financial markets, you're interpreting the price actions. Sometimes you don't have visibility over the economy, or in fact no one really has the full picture. You're seeing a little snippet of it based on your media consumption might be quite different. We're seeing different parts of the global economy. We talk to different people, and markets are all about bringing those different opinions together and trading them against each other to try and find some element of truth. Perhaps that's the right way of looking at it, as to where what's really happening in the world. So I think that's possibly also why you get this in financial markets. You get this sort of big dislocations between people's hopes and dreams, or on the flip side, the despondency in the bear market, and what the actual real picture is in the real economy.
Yeah, and I think just like gambling, it's probabilities. If you can, as you say, use your risk management to your advantage and find the right, most probable outcomes, like we say with carbon, it's probably most likely that it's still going to be here in 10 years. I think that politicians have sort of put their foot down and decided that this is the path they want to go. And I think it's going to be really hard, given the mechanisms they've put in to shift that sentiment. Just before I let you go, what do you think about that? Do you think that the politicians could back off this, or do you think that this is kind of just the way forward regardless?
Well, I think that it all comes down to sort of commitment. So individual countries like the UK and several others as well have actually committed to net zero in law. So there's a legal obligation on the politicians, on the government, to actually to move forward with the agenda, the commitment set out in those laws. And it's not just individual countries, whole, the UN, global, groups of countries have come together to, set out their vision for the future. And that's only accelerated over the last, certainly since 2015, but, certainly over the last few years as well. So, there's always going to be these, changes in narratives, in sentiment over time, whether that's due to an energy crisis, geopolitical risk, a financial crisis. Those are always going to, buffet that or make people question that commitment. But I think, these issues, the real impacts of climate change are becoming, more and more evident to, people all around the world, that, if governments were suddenly to, say, or sort of gradually sort of sweep it under the carpet and, and quietly drop it, then I think there would be, there'd be an uproar, eventually as to, why aren't you actually doing anything about this?
Yeah, for sure. And climate change is one of those things that, there's obviously opinions everywhere and everybody has their own ideas. And for me, like, I'm not a scientist. I don't know what's going on with the climate. All I want to do is figure out where the money's going to flow. So, if it's going to be into carbon free net zero, then, that's a place that I want to invest. And if the energy grid is going to remain fossil fuel intensive for longer than people think, then I'm probably going to invest there too. And it's for me, it's not political. I want to try to find the best investments for my earned dollars.
Yeah, absolutely. I think you need to keep to put your own personal, preferences or, philosophical ideals of what their politics or, the economy should look like. And it's, it's about, as you said, it's about, interpreting where things are going to be in the future, not how you'd like them to be necessarily.
Yeah, and I think that's really difficult sometimes for investors, because there are ways, like if you some people might prefer to put their money in what they believe in, and from a moral standpoint, and I do to some degree, but it's just whatever line you're willing to cross. And depending on how far you want to dig, you can find issues anywhere. So it is what it is.
Yeah, and that's as you said, that's all personal. It's up to individual preference.
Mm-hmm. Yeah, for sure. But yeah, on that note, I think that this has been a great discussion. I wonder, I could just like to give you the opportunity to share where people can find your content. And
no, thanks for inviting me on the podcast. If people wanted to get in contact, you can see my writing on Substack, and it's Carbon Risk is my newsletter there. Also, perhaps I'm less active than I used to be, but certainly on Twitter at Peter Sainsbury 7.
Okay, awesome. Thanks so much for coming on. It's always a great discussion. I appreciate it.
Okay, thanks very much.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice.